You have probably felt it before. You stare at the screen, you do your morning analysis, you finally click the buy button, and then it happens, almost instantly. A cold, heavy knot forms right at the bottom of your stomach. Your breathing gets a little shallow. You lean in. You look at the chart again, and suddenly the setup you thought was brilliant just 3 seconds ago now looks like a child's finger painting. The structure is broken. The volume is weird. You realize, with a sudden wave of quiet panic, that you are not sure about this trade at all. The market is not making sense. Do not freeze. Do not close your eyes and pray to a market god who has never once listened to you. You are acting inside a rigged game. The financial markets are not built to be clear, gentle, or fair. They are giant, chaotic machines designed by billionaires and highly tuned algorithms to extract money from normal people who are just trying to find logic in the madness. When you feel that knot in your stomach, you are not being weak. You are a rational human being suddenly realizing you just walked into a dark room without a flashlight. When the market conditions suddenly become choppy, your primary objective has to change immediately. You are no longer trying to buy a yacht, you are just trying to keep the boat you already have from sinking. Your goal shifts entirely from wealth generation to capital preservation. You need a defensive protocol, you need emergency rules to protect your money from the market, and to protect your mind from yourself. I know exactly how rigged this game is, because I used to watch it from the inside. When I worked as a prop firm data analyst, I had unrestricted access to the back-end servers. I analyzed the raw data of thousands of traders to find the exact mathematical difference between the 1% who take home massive payouts and the 99% who quietly blow their accounts. I took all of that classified data and put it into a new book. You get the unrestricted server truth. It shows you the exact win rates, risk-to-reward ratios, and daily loss limits of the top 4,000 traders. It gives you step-by-step, mechanical rules to physically force patience, control your fear, and survive your drawdowns. Stop guessing. Mechanize your mind. The link to the book is in the description. Here is what you do. We have all been sold a very specific lie by people on the internet. It is a common belief in the trading world. You have heard it 100 times from guys recording videos in rented sports cars. They tell you that to be a real, profitable trader, you must always aim for a massive risk-to-reward ratio. They say you must risk $1 to make $3, or $4, or $10. They make it sound like a law of physics. So you sit there in a terrible, choppy, confused market holding your trade. You are up a little bit of money, but you do not close it. You need your $3. You wait. The market hesitates. The market turns around. The market drops violently, blows past your entry point, hits your stop loss, and takes your money. Holding out for a massive win in a market that does not know what it is doing is an act of quiet insanity. Unsure markets do not trend smoothly. They gasp. They choke. They move a little bit in one direction and then immediately reverse to hunt for liquidity. Expecting a choppy market to give you a clean, massive run to a huge target is like expecting a wild animal to do your math homework. It will not happen. It will only bite you. When in doubt, you must abandon the home run mentality entirely. You downshift your expectations to a rigid 1-to-1 risk-to-reward target. If you are risking $50, you target $50. You take the base hit. In a bad market, a 1-to-1 target allows you to grab a tiny bit of profit during the very first random impulse move before the market inevitably changes its mind and reverses against you. Dropping your targets like this actually increases your win rate when conditions are terrible. It feels wrong because you have been trained to be greedy. But a rigid 1-to-1 strategy during a bad day keeps your account balance stable, while everyone else around you is slowly bleeding out. Lower your target. Take the money. But taking the money early is only part of the solution. We have to talk about the physical symptoms of your anxiety. We all know the physical feeling of risking too much money on a bad idea. Your hands get a little sweaty. You find yourself leaning closer and closer to the monitor, as if being nearer to the pixels will somehow force the price to go up. You have the heart rate of a hummingbird on espresso. Why does this happen? Why do we feel this specific brand of panic? It happens because your financial exposure does not match your level of confidence. It is a mathematical imbalance. You are risking your standard 1% or 2% of your total account on a setup that your own brain knows is terrible. You are paying a premium price for a discounted, broken product. You are treating a completely random 50-50 coin flip with the same financial respect as a high-quality, perfect setup. Your body is reacting to the fact that your math is completely wrong. The solution is brutal and immediate. slash your lot size. If you normally risk $100 on a trade, and you feel that knot in your stomach, you must cut that risk in half. Better yet, cut it to a quarter. An unsure setup should risk almost nothing. Reducing your lot size does something magical. It instantly removes the emotional anxiety. When you risk a tiny, irrelevant amount of money, the market loses its power over your nervous system. You stop sweating. You lean back in your chair. You watch the chart with cold, dead eyes instead of desperate hope. Halve the risk, survive the trade. Now, once you have slashed your lot size, you unlock a strange, hidden mechanism in risk management. This is where we break another rule that everyone thinks is gospel. Here is a wild, slightly uncomfortable truth. A wider stop loss can actually lower your overall risk in a bad market. Most retail traders think a very tight stop loss is the ultimate protection. They place their stop loss just a few pennies below their entry. They think they are being responsible. They think they are being safe. But in a noisy, unsure, violent market, a tight stop loss is not a shield, it is a target. The algorithms and the big money players know exactly where you put your tight stop loss. They hunt it. They will drop the price just enough to trigger your tight stop loss, take your tiny loss, and then immediately reverse and go exactly in the direction you predicted. You die by 1,000 tiny cuts. You lose 5 trades in a row, all of them tiny, but together they destroy your day. You are right about the direction, but wrong about the room. So, you change the math. You trade smaller so you can trade wider. Because you just cut your lot size in half, you can now take your stop loss and double the distance. You push it way down, far away from the noise and the chop. You are risking the exact same dollar amount as before, but your trade now has massive room to breathe. You are no longer affected by the random, violent wicks that hunt retail traders. You have bought yourself the cheapest, most valuable commodity in the entire financial world. Time. You bought time to see what happens. But even with extra room, bad trades will often stay bad. The market will slowly drift against you. Your screen will turn red. And this is where human nature takes over, and where smart people do the absolute dumbest things imaginable. When a low-confidence trade starts going red, a very specific psychological trap opens up. Traders hate losing. We are logical beings. We want to be right. We want to fix our mistakes. So, when the price drops, our brain tells us a very convincing lie. It tells us that if we just buy a little bit more at this new lower price, we will bring our average entry price down. We tell ourselves that if the market just gives us one tiny bounce, we can get out at break even. We will not lose anything. We will fix it. This is called averaging down. It is the financial equivalent of setting your kitchen on fire because you wanted to keep a single match lit. When you average down on an emergency protocol trade, you are taking a setup that you already doubted, a setup that is actively proving you wrong, and you are throwing more money at it. You are taking a very confident mistake and making it expensive. If you were unsure at the beginning, why are you suddenly aggressively confident now that you are losing? It makes absolutely no sense. The market does not owe you a bounce. The market does not care about your average entry price. The market will drop and drop and drop until your broker sends you an email telling you that your account is gone. You must implement a strict, non-negotiable total ban on averaging down. Under no circumstances do you add money to a losing position when you are already in doubt. If the trade fails, and it hits that nice wide stop loss you set, you accept it. You take the micro loss. You close the laptop. Do not add money. Just walk away. There is one final rule. It is the hardest rule of all, because it requires you to fight every single dopamine receptor in your modern brain. Sometimes, you look at the charts, you draw your lines, you check the volume, but the structure is completely illegible. It looks like static on an old television. You feel an overwhelming sense of doubt before you even click the button. Most traders view this self-doubt as a psychological weakness. We live in a culture that tells us to take action, hustle, execute, do not hesitate. So traders force themselves to take the trade, believing they are conquering their fear. They click the button just to feel like they are doing something, but they are entirely wrong about what that feeling is. In reality, feeling unsure is not weakness. It is usually your subconscious pattern recognition doing exactly what it was evolved to do. You have spent hundreds of hours looking at charts. Your brain has absorbed millions of data points, shapes, and movements. When you feel a sudden, inexplicable doubt, It is often your subconscious noticing a subtle, dangerous shift in market volume or price action. It sees a trap long before your conscious speaking brain can actually put it into words. Listening to that doubt is an absolute superpower. The ultimate defensive rule, the highest level of trading maturity, is simply to sit on your hands and do nothing. We forget that cash is a valid position. Sitting in flat cash, taking zero risk, and preserving 100% of your capital is often the most profitable decision you can make on a bad day. You do not have to participate in the chaos. You do not have to prove anything to the screen. When the game makes no sense, you do not play. Cash is a position. Trading is not about being a hero. It is not about proving how smart you are, or fighting the market until it bends to your will. The market will never bend. It will just take your money and move on to the next person. Your only job is survival. The next time you enter a trade and feel that sudden knot in your stomach, do not ignore it. Do not hope for the best. Drop your targets to a simple 1-to-1. Slash your lot size into a fraction. Widen your stop loss so you can actually survive the noise. Never, ever add money to a burning room. And if the doubt is too heavy before you even start, just turn the machine off. It is better to be slightly bored with your money safely in your account than to have a heart rate of a hummingbird while you watch it all disappear. Protect your money. Protect your peace. And if you cannot do that yourself, you do not need another magic indicator. You need a machine that enforces your discipline when your human brain panics. That is what the Alpha Equity Manager does. If you set a daily loss limit of 2% and the market hits it, the software does not ask for your feelings. It instantly closes every open trade and completely disables your buy and sell buttons for the rest of the day. You are physically locked out. And if you try to bend the rules and change that limit to 3% while you are stressed, you can't. The time-locked vault simply rejects your emotional input. You cannot cheat it. Add in a tool that shows your exact dollar risk before you even click the mouse, and your account becomes practically bulletproof. The link is in the description. Let the machine protect you.